Today we're looking at gold because it seems like there's a really, really good chart setup appearing. And then the trading takeout is going to be expect the best, prepare for the worst, but then capitalize on what comes. We're going to try and understand what that means in a trading context. But before we get into today's videos, please do like this one, subscribe to the channel to make sure that I pop up in your YouTube feed every day, giving you the best trading tips and market commentary to improve your trading edge. So gold seems to be in a little bit of a bear flag. That was the first thing that I noticed when I pulled up the chart this morning. So if you see this channel here, that tends to be relatively bearish, and it's right into the 50-day moving average. You can see it's already ticked down today so far. Now, from my view, we've got sort of this range, I guess, forming, which you could say is the 200 daily as support. And then we've got the 50, and then maybe, you know, a little bit higher up, we've got this kind of range here at 2063-ish. So there are multiple supports here, but it feels to me like a new range is sort of forming. So you've had this one up here sort of, and then what I think is going to occur is we start to see the market tick down. This is roughly 50% of that range. So it's mean reverting. It's in mean reversion mode. It ticks down now, and we shift down to here, and then it creates a new range sort of between these two. And then we would probably see it head lower, something like that, because what we have to expect is that the market trends about 30% of the time, trends quite hard 30% of the time, but it's in ranges about 70% of the time. So this is something that we definitely need to take into account with regards to gold. Now, with regards to the fundamentals backing gold as well, if we look at the US 10-year yield, okay, we can see that the yield is up while inflation is relatively flat. You know, we saw a tick up, but it's relatively flat still. So this is basically leading to an increase in real yields. You know, if the yield is increasing on a 10-year treasury bond while inflation is flat or decreasing, it means that there's an increase in the real yield of gold. And you can see here the real yield, the 10-year yield, is above the 200 daily moving average and also above the 50. This is quite interesting considering, you know, we are expecting the Fed to actually be cutting rates come June, you know. So this is an interesting phenomenon that we're seeing because the market is in sort of disbelief mode, I guess. You know, the market is saying, we don't really believe that rates are going to come down that quickly, which is quite concerning considering the actual chart of inflation. So let me just get the US inflation number up. So if we look at the United States inflation rate year on year, we can see that there are some similarities, some, not loads, but some similarities with here, with the mid-70s when we actually saw inflation come right back down, but then it skyrocketed again. Now, that would be completely terrifying if that would happen. I think the world would explode if we saw a resurgence of inflation to that extent. But you can sort of see where I'm going with this. You know, it's not quite down to those levels and the longer-term average that we saw, you know, post-2008 and these years. It's not quite down to here. So I would be averse to saying that the inflation problem is completely over just yet. I think it still takes a few more months to go. And so with that, we just got to be very, very cautious. But in the short term, gold, in my view, is ticking downwards purely based off of the view that real yields are higher. If we look at it from a technical perspective, you know, you can even see it's forming sort of a head and shoulders as well. So interesting stuff going on in gold. I think that this will be the new range for a bit, you know, probably down to here. It would be interesting to touch the 200 daily moving average. If we push through 2K, then it's likely to be a psychological number. Algos could come into it, leading to a broader push lower. But we're a long way from there yet. So just pay attention to gold, focus on the fundamentals of real yields higher, and you should be okay. Today's trading takeout is expect the best, prepare for the worst, and capitalize on what comes. But what does that exactly mean? So realistically, you should be going into every trade with some confidence. You should be expecting the best. And you can do this via having adequate position sizing and giving yourself room to breathe, not having a really, really tight stop like 10 pips away or anything like that. That's completely silly. You should be entering with a relatively small amount of capital first and scaling in. This is probably the most advisable way to get into a market rather than just chucking down a full position. You want to be careful. You want to be slightly adverse initially. Then, preparing for the worst means having a disaster stop. Where will you completely get out of the market when you're wrong? You've always got to think of when you're wrong. And the best way to do this is to think of objective measures. Maybe look at, average true range and setting a stop outside of there, because then you're basing it on data, not just your perception of where you should be wrong. And you can replicate that over time and then measure it and test consistently. That is the importance of using objective measures. Capitalize on what comes. It means basically, ensure that if you do get onto a winner, that you are managing it as best possible. But equally, if you get onto a loser, you manage that as best possible as well. You might have to scale out if you start to lose. Now, these are advanced techniques, but it's important to note them so that you can move forward and understand where you need to get to, because otherwise, what is the point?